it away.
Awesome, man. Well, Matt, thanks for having me train tonight. Let's see. This will stop other screen sharing. Do you want to continue? Yes. Can you guys see my screen? So yeah, no, Matt, appreciate you doing this every week. I know that there's several people on my team who have benefited from this training every week. And let's see some chat. One thing I am terrible about following the chat at the same time as doing the training. So if somebody wants to be my chat person, that'd be awesome. But yeah, no, I definitely am excited about this training that happens every week. And like I said, I know several people from my team have done really well being on here and have learned. Of course, we've got some amazing trainers on here. Matt himself is incredible, and Dr. Bacon and Jay Wayne. Everybody knows Jay Wayne. Curtis. We've got some really good trainers, and now just in the last couple of months, we've had the privilege of adding Clint to the trainers, and he's probably taken all the things that we've done and gone even to the next level. So I think that's really incredible. Tonight, what I'm going to do is I'm going to go over some market structure principles, and really I'm just going to be talking about what it is I do when I trade. Everybody, first, let me just say that everybody is going to have their own style of trading. Everybody's going to have their own strategy that works for them. There's no right or wrong way, I guess you could say. Well, I guess the wrong way is to use bad risk management. But when it comes to strategy, there's not like a right strategy and a bad strategy. Like, a bad strategy is just one that doesn't work. If it works for you, and if you're seeing market principle, then it's a good strategy. So what I do may not be exactly the same as what Matt or Dr. Bacon or Jay Wayne or any of these other people do, but it works for me, and so we're gonna talk a little bit about that. So my favorite pair is GA. If you've traded with me at any point, you know that my favorite Forex pair is GA. Some of you see that I like to trade gold as well, but as far as the actual currency pairs, GA is my favorite pair. It's my baby. I trade GA all the time. This is it's the one that I constantly stick to when I'll kind of venture out and trade EA a lot. I'll trade AJ when I'm scalping. There's some other things that I look at a little bit here and there, but when it comes to my constant, GA is that thing. And the reason is it's so interesting when you look at, like, if you were to go to any of the other pairs, let's say USD JPY, and you could see this move right here, and it would be like 50 pips. And you look at it on here, and it's like 150 pips. You get the most bang for your buck when you're trading the British pound. And so I love trading the pound. The Aussie dollar I like trading as well because of its correlation to gold. One thing I'll say really before I look at the charts is that, and I actually learned this from Matt McCormick, is that one of the biggest things to me in confirmation is not necessarily the time frames, although we do look at time frame trading. Maybe I'll mark up on the daily chart, trade on the 4-hour chart. Sometimes even I'll find entry on the 30-minute chart. But ultimately, the greatest confirmation is not necessarily the different time frames, because what you're looking at on the daily time frame is the same thing as what you're looking at on the 4-hour time frame. It's the same thing you're looking at on the 30-minute time frame, just dissected differently. So to think of it really simply, inside of every 1-day candle are 24 1-hour candles, 6 4-hour candles, 48 30-minute candles. So if you were to take one of these 4-hour candles here if you were to take one of these and dissect it and take the guts out of it, if you would, there would be 4 1-hour candles inside of it. So when you look at the 1-hour chart, you would see 4 candles instead of just 1 candle, and really just getting the same information, maybe just a little bit more detailed. So for me, I don't necessarily only look at for confirmation on different time frames. I might look for entry on different time frames, but for me, I look at confirmation, and I look at confirmation based on different pairs. And so somebody just asked why I chose GA, which is what I'm getting to right now. I think that when you look at different pairs, not only do we find confirmation, if I'm looking at GA, let's just say, and I'm looking at a strong bullish movement like it has been, I need to go and see GU. Let's see if I'm having bullish movement. I want to go see, GN. Let me see if I'm having bullish movement. I want to look at GJ and see if I'm having bullish movement. Is the GBP the pair that is strong, or is it the Aussie that's weak? That really, when you look at trading, you're looking at one or the other, okay? Or it could be both, and that's the even best case. In GBP AUD, if we're looking long, we're looking for a buy, bullish movement, then one of 3 things could be happening. Either GBP is really strong, or maybe GBP is standing still, but Aussie is really weak. Or it could be a mixture of both, GBP being strong and Aussie being weak, and therefore we have straight up and down movement like we've had. Now, to answer the question that just came, I don't know who asked that, but to answer that question, I look at correlation, okay? For an example, probably the easiest correlation is the Aussie dollar. When we do just a little bit of research, we understand that the JPY, for an example, the yen, the Japanese economy is built on export. So they generally are going to want the Japanese yen to be low in price. You're going to see most of the month where you're going to see the yen cycle faster and drop harder, because they want the price of the yen down so they can export lower. Okay, does that make sense? And now you have the US dollar, for an example, is a stronger currency because we are an economy built on spending money. Okay, we're a capitalist economy. We're based on spending money. The more we spend, the more demand for the dollar, therefore the dollar price goes up. So it's the same thing for the Aussie dollar, which is why I choose the Aussie dollar over trying to trade GU or GJ. Not that you can't trade those very successfully, but because the Aussie dollar, their economy is very centralized upon metals, gold, silver. These things have a large play in how the Aussie dollar moves. And so when you look at the Aussie dollar, AU, for an example, Aussie dollar, US dollar, many times it's moving the same way that the Aussie USD is moving. Many times it's moving the same exact way, because the gold and the Aussie dollar are basically moving in harmony with one another. So because I like gold, because I like the way gold moves, gold is generally going to be opposite of the US dollar. If the US dollar is going up, gold is generally going down. Gold is going up, the dollar is generally going down. Of course, that's not a 100%, but it's a pretty standard rule. So therefore, if I'm looking at GA, I can look and basically be looking at trading the same way I would trade a gold pair. So if that makes sense. Now, one thing I will say about this, about the way I trade, is notice on my chart here, and I'm trying to move these little videos out of the picture, but notice how I don't have any of my indicators on the screen. Now, I'll just tell you straightforward, I do not have the pro account of TradingView. I do not think I need the pro account. Now, it'd be nice to be able to show different time frames and all that kind of stuff at the same time. Look, I'm not interested in that right now. I only need 3 indicators to trade with, and really I don't even need those. Okay, when I look for a trade, I am not even using an indicator. Let me say it this way. I know, and I don't want to. Please don't take me the wrong way. I'm not downing anybody else's strategy or anything like that. But what I am saying is that trading indicators is really you're going to lag behind. Indicators are reactive to the market. An indicator does what the market is telling it to do. So when you look at a moving average, let's just throw this moving average up there. A lot of people will throw a moving average on here and see when it goes above, it means buy. When it goes below, it means sell. That's cool. It works. However, a moving average, in this case, I use a 9 exponential moving average. A moving average is basically just going to be the average price of the last however many candles that period is set at. So in my case, 9. So it's going to take the price of the last 9 candles, average it, and this is where the average price of that is. In other words, price is always going to try to get back to that norm. This is the norm for the last 9 candles. So price is going to try to get back to it. It's going to try to act like a magnet. However, how does it know the average of the last 9 candles until the 9th candle is done? So you're always going to be lagging behind. If you're trading indicators, moving averages, crossovers, things like that, which are all good, none of them are bad. But if that's your primary way of finding a trade, you're always going to be a tick behind. Now, it may not be a lot. It may only be just a second. But a second is a second. And I don't want to be behind the market. I don't want to chase the market. I want to be ahead of the market. When price is moving, I don't want it to already be making its move. And then I'm saying, all right, well, now it's bullish. Let me get in. I want to know when it's going to go bullish. I want to know when it is going to turn around and make that turnaround in the market. So I don't want to wait for indicators to tell me something. I want to look and see what market structure tells me all in and of itself. Because, and if you're taking notes, write this down. Indicators are reactive. Indicators by nature are reactive. Okay. Now, price action trading, looking at numbers, that is predictive. Trading based on what supply and demand zones, and trading a naked chart like you see here, that is predictive. And so now all of a sudden, instead of being behind, I'm ahead of the market. Instead of being behind and saying, oh, the market's making its move, let me try to chase it. Now I'm ahead of it and I'm anticipating what the next move is going to be. Okay, I hope that makes sense. So what I do is I will look at the price of the market, and now I don't mark it out like I've done it enough at this point where I don't have to write every line on the chart. But just for your sake, let's look and see. These whole numbers are very, very important, which is why I got my screen zoomed the way I do. These whole numbers are very, very important. Many of them are what are called quarter points, and if anybody here has ever studied wave theory, and if you're familiar with Elliott wave, then you'll know that inside of every wave is a wave. Inside of every wave, that's why we see these wicks on top of every candle. Okay, when we look at a wave, up, down, up, down, up. Okay, that 5 series wave, we're gonna see up, correction, and that whole part of it is part of that correction. And we see up and down, and every time you see a wave, each one of those waves has a wave inside of it, which is why we don't see a green candle just go all the way to the top. It'll go up and then down, and then up and then down, and then up and then down, and then up, and then drop back down. It fluctuates constantly because the market is constantly fluctuating, and every wave has a wave inside of it. Well, that is the same with market structure. It is the same with quarter point theory or quarter theory. It is the same with price action trading. Every major quarter has smaller quarters or minor quarters inside of it. So if I were looking at from 170 to 180, from $1.70 to $1.80 is a major zone. Okay, you're talking about 1,000 pips. Now, if inside of that 1,000 pips, every 250 would be a quarter. So 72.50, 75, 77.50, or 77.50, and 180. All of those would be major quarter points. Now, again, just to be very clear, inside of those are smaller quarter points. In between 74 and 75, which is only 100 pips, but in between 74 and 75, you have 74.25, 74.50, 74.75, and then finally 75. So inside of each one of those, which is why you see the movement go up and down slightly on its way to make the bigger up move. I hope that makes sense to everybody. Those numbers are very, very important. It's not a luck and guessing game. Well, it's going up because, well, it's going up. No, that's not it. It's going up because there are certain levels in price where the banks are going to do business. If we're honest with ourselves, guys, we're going to understand that the banks are constantly manipulating the market, and we're not going to beat the banks at their own game. Anybody who has been on any of my trainings has heard me talk about the fact that we are not going to beat the banks at their own game. The banks are going to squeeze every penny out. Now, somebody type for me if you've been in a Forex in an IML presentation before where somebody's done an overview. How large is the Forex market average every day? Can somebody type that for me? What is the volume? Somebody said exactly 5.3 trillion a day. So now let's think about that for a second. If currency is going to be sold at, let's just say, $1.84, okay? Let's look at it this way. If currency is going to be sold at $1.84, it's going up, and they're looking at selling it at $1.84. If they can sell it at $1.8410, which is only 10 pips to us, that's nothing to us. Okay, that's only a tenth of a penny to us. And so for me or you, if we say I saved a tenth of a penny, well, we would say, oh, that's not very much money. But if you took a tenth of a penny times 5.3 trillion, now that's a whole lot of money, isn't it? A tenth of a penny times $5.3 trillion, you're talking about a whole lot of tenth of pennies. And so you're talking about millions and millions of dollars in the market that the bank would make extra by having that extra little tenth of a penny in the market. And so I'm saying all that to say this, guys. The banks are going to manipulate. Yeah, there you go. That's great math, Clint, because you're ahead of me. But if the banks are going to squeeze out a tenth of a penny times that 5.3 trillion, then of course, that's a lot of money that they're going to make. And so what they do, there's a principle called batching, and I've said this a lot. If you've been in any of my trainings, I've talked about this. But if you've ever worked at a grocery store, and let's just say, for an example, before I get into the charts, I just want to kind of help you understand. Let's say you worked at Walmart or Kroger or something, and they have based on maybe the demographic of where that store is, based on the volume that store produces, based on the time of day and busy and slower times of day, based on the time of year that shopping, busy or slower times of year. They have a predetermined number that when a cashier goes to the register, they have a predetermined number in that register. So let's say that register is going to start out with $1,000 in it. Okay, their goal is they don't really want that register going too much over $1,000. That's what they're going to start it with. So now, let's say that cashier goes out to the register and they take the first customer, and that customer spends $100. So now there's $1,100 in the drawer. Well, you don't see the manager come out and take the profit. Let me get that $100 and bring you back down to 1,000 after each individual customer. That wouldn't be very efficient. That wouldn't make very much sense. It would be spending man hours for no real reason. But they do have some predetermined price points that they don't really want to have too much more that in the register than that. So let's just say that number is 2,500. So what'll happen is they might take 20 customers or 30 customers, and then now that register gets up to 2,500, and then you'll see the manager come out and they'll shut down the register, usually when there's like 50 people in line, which is so obnoxious. And they'll shut down the register, they'll count the drawer, make sure there's no overages or underages. They'll make sure that the numbers are correct, and they'll bring that drawer back down to 1,000, take the profit out, and instead of filling one order at a time, each customer at a time, they'll fill all of those orders based on that price at one time, bring the profits back to the safe, and bring the register back down to 1,000. That's called batching. That's when they take multiple orders and fill them all at once. Well, the banks do the same thing. If the U.S. buys 50,000 cars from Japan, well, the bank's got to fill that order. But then, Tesla buys, car part, computer chips or something from Japan, and then another company buys car parts, and another company buys some other type of material. There's a lot of orders going on at one time in the U.S. Japanese economy, and so they don't fill those orders one at a time. They will have certain price points in the market, and those are called quarter points. They have those price points in the market that they're going to fill all of those orders at a certain price point to squeeze every penny that they can out. Because again, a half a penny or a tenth of a penny that they can squeeze to fill an order is going to be millions of dollars of extra money for them. And so the banks are rich for a reason. Does that make sense to everybody? Type 1 in the chat if that makes sense to you. Awesome. So with that being said, what we do, or what I do, is I trade price action. I do not go to my indicators to tell me where price should be or what price should do, because the indicators are not telling me what price should do. They're telling me what price has done. And so again, now if I'm only using indicators to get me into a trade, I'm chasing the market. Even if it is, albeit just a little bit, I'm chasing the market. And so I don't want to chase the market. I don't want to go against the banks. I don't want to try to beat the banks at their game, because it's not going to happen. I want to play the game with the banks, not against them. All right. If you go online and Google Forex, you're going to find, I think the number's around 70% of Forex traders blow their account within the first 4 months. Some of us on this call have done that very thing. All right. The reason they do that is because they're trading against the banks and not trading for or with the banks. Okay. They're getting in trades based on, oh, it's green, let me get in. Oh, it's red, let me get out. But with constant corrections in the market, with constant wave theory, with wave inside of wave, with quarter point major having minors inside of it, there's always going to be fluctuation, and we end up getting in against the market. So I say all that to say this. Let me go to, I did some marking up just a little bit, just to kind of show you what my chart generally would look like. All right. So if I'm trading, this is generally what my chart is going to look like. All right. So what I'm going to do is I'm going to trade off I'm going to show you the replay. All right. Let's go back here. And if you go all the way back to here, everybody should be looking left. Okay. Now notice I don't have any indicators up, but everybody should be looking left. what the market has done is what the market will do. All right. And if we go back, we're going to see two very important zones right here. We're going to see this zone right here, and we're going to see this zone right here. Okay. And what was support will eventually become resistance, and what is resistance will eventually become support. All right. So what do? We look left, and we identify certain zones. Now here's the cool thing: if we go way in like this, you'll see that those two zones have been important. They're not just important now; they've been important, and I don't have to look very far left to see these zones. So here's the cool thing, guys. I was doing a training with my team the other night. I think it was Thursday or something, or Wednesday. And while we were on a training, I told everybody there's a certain zone coming up that if we break it, we're going to be going really hard into a bullish market. And sure enough, during that call, we ended up breaking that zone. And by the time the call was over, about a half hour later, we were up 90 pips bullish. Since then, it's gone over 300 pips bullish since then. So I'm going to show you how I understood that. Well, I had this zone right here that was structured, okay, which you can see some patterns in there as well, which I won't get into tonight. Then I seen this zone up here that had some structure, okay. So now if I know that I have a zone here, then I'm going to look and see for a break. I'm going to see what happens in this zone, you know, back down here. It's down here, comes up, it goes all through here, comes back down, gets into my zone, and finally it breaks. And what used to be a zone on the bottom is now a zone on the top. So now if I'm gonna look bullish, which at this point I'm not yet, but if I'm gonna look bullish, then I would need to come and, you know, break this zone, this same zone that I've had to break in the past. I'm gonna have to break this zone again. Okay. Yeah, 1 second here. Yeah, so this zone that I've had to break in the past, I would need to break that again if I'm going to go bullish long, you know, bullish on a GA trade. So what do? I look and I see you know, this constant zone. I see this constant zone. Look, it touches, 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 touches. Actually breaks through and touches the other zone, all up in here. Okay. Comes down, touches, breaks in, breaks out. Now here's what's interesting. The first time, now here I have this strong bearish movement. Then it comes up. Now I'm looking to see if I can set what? Another lower low for a bearish trend. Because this would have been down, a new low, higher, lower high. Now I should be looking for a lower low if I'm going to continue bearish. But what do I end up having? I end up having a higher low, which now causes, it's really not even a counter trend because it's not really a true trend formed yet. But I have this counter trend that's forming. So then I'm going to wait and I'm going to say, well, if it goes to be a higher high, then what would it have to do? It would have to get past this, which would mean it would either have to break my zone or it would at least have to push into the top of my zone. So this zone that I marked way back here, this zone that I marked back here becomes important up here, and I haven't even seen this yet. Okay, so in other words, for this to come, it touches my zone, it comes down, forms a higher low, which tells me I should be now looking for a higher high if I'm going to have a bullish trend. So what happens? I come up, I go higher than the previous high, and let's go. And now I'm starting to see some down movement, which sets my high right at the very top of this zone. It did not break the zone, but it got to the very top of the zone. So now I have a low, a high, a higher low, a higher high. What does that mean, guys? That means a bullish trend. So that's when I drop my line right here. Just all I got to do now is just see what happens. I know that from here, if this is going to continue as an upward trend, it would need to retest and then go up. So from here, I'm gonna probably be looking at. I probably wouldn't be trading it, but I'm probably gonna be looking at something coming down toward this trend line. So what happens? We start replaying. Let me spread that out a little bit for you. Okay, and it comes right down to my line within just a few pips. And now what should I be looking for? If this is going to continue to be an upward trend, then I need a higher high. I need for something to continue. Now again, there's little waves in there. That's not going to throw me off the overall trend. So then I have a strong move up that pushes me into my zone. Guys, that's called an engulfing candle. All right, this engulfing candle just engulfs 1, 2, 3, 4, 5, 6, 7. I mean, way back. This just engulfed a couple of days worth of movement. So that right there, that was a strong buying pressure move. That tells me that we're about to see some strong buying pressure in the market. Right at my trend line, trying to set a new high, and I get strong bullish movement, which means that now I'm probably going to come down. I'm going to retest somewhere in here, which probably could have even happened on this candle. And then I'm going to see strong bullish movement. Guys, this stuff is no-brainer. This stuff is a no-brainer. Comes up, top of that candle, comes back down to retest. Okay, ends up closing right here. So I have somewhat of a retest right here. I have my engulfing right here, and then I have a strong move up. By this time, we should have been making money. Okay, this is just absolutely unreal. So then I start to see my retest. So at what point would you would take entry on your trend line? At what entry? Okay, so I'm going to get into the entry point in just a second. I just want to show you the overall thing here, and then I'm going to show you the entry. Okay. So I want to show you something here. Let's go back. Let me go back to right here. Now, market structure is very important. Remember that other important zone I talked about? The one that was down here that I formed the zone here, and this other important zone that was right here? Well, once I have that bullish movement, now I've got a high, a higher low, a higher high, a higher low, a higher high. Once I break through this level, I'm going to need a retest off of that level because I know that that's been a major level. How many times did it take to break that before? You know, this was a strong level before. So it's probably not just going to fly through that level and never even think about it. And if it does, I mean, not that it can't happen, but because we know that that's a very strong structure point, I'm gonna probably be looking for a retest here. Okay, I'm gonna be looking for something to slow down somewhere in here. And so here's what happens. I get my retest. Look at that. Look at that. It tried twice to get onto that, back into that zone. Comes up here. Now I don't have this marked, but I just want to show you the very top. You look here. Let's drop a line. Very top of here. Look exactly where it needed to retest. Market structure is everything, guys. Market structure is everything. Everything you need. Right on that line, it retested. Okay? So, let me delete that. Let's keep going just a little bit. Got right up to that line and retested. Now it broke through. New week starts. We see some down movement. Look where the down movement ends, guys. Look at the zone. It's right back in again. This price action trading, understanding market structure, it's everything. Look at it. Try it again. Try it again. Yes, what was resistance before, actually what was support before became resistance and then became support again. This zone has been strong, and actually I looked at it earlier. We won't do it right now, but just because of time's sake. But when you look at it, you can go back years, and this same zone has been strong structure point for years in this pair. So although when we look at yeah, awesome. Although we look at this and say, wow, what a strong move up. Really, when you look at the overall picture of GA, when you look at what it's done for a while now, this really is just a correction. This is really just GA getting back to where GA generally operates. This is not anything special that GA is really doing, except that it's getting back to where GA generally operates, okay? So just real quick, I don't want to take too much more time, guys, but let's look at what it's doing. Kind of fly through this. Now what do we have? We have another higher low, higher high, higher low, and another higher high. I haven't told you anything that you didn't learn in basic 1. I haven't told you anything that you haven't learned in base with outside of basic 1 through 4. I haven't looked at an indicator. I haven't shown you anything except for what price action trading looks like. And guys, this stuff is a no-brainer. Look at this. Now this is where the market is currently. Okay, so here's the interesting thing. So you asked me where would I find entry? We talked about entry. Well, here's where I would have found entry right here. Because again, I don't just trade based on emotion. I don't trade based on any one thing. I trade based on price action and market structure. So if I knew that this zone was marked up since way back then, this was my zone that I'm going to have marked up. This is the zone that I always have marked up on GA when it's in this price point. And so what I'm looking at here is this market structure. I'm looking for it to get up into this zone. Now, some of you would say right off of the trend line is where I wanted to trade. Now, sure, in this case, you could have. But as you know, and as any of you have ever experienced that have tried to do anything just off of one confirmation, it'll go up and then it'll drop down, and then suddenly you'll form a counter trend. So what I generally will do is I know that I have. Okay, that's another question. Keep it simple. Simple is where the money is. That's exactly right. So when you have this zone right here and you have this trend right here, guys, think about it like this. There's a lot of space in between here and here. So I don't really know what the market's going to do. That's a lot of wiggle room, if you would. It could go up here and then back down here and up here and back down. There's a lot of movement. But I have a trend line and I have a zone. That's not very much movement right there. That's a pretty small little zone right here. That's a pretty small little zone to look at. So guys, when you mark your chart, mark it simple. Mark your market structure first. Find your trend lines, your support, whatever you're trying to find. And then now, instead of looking at this, if you can see my mouse moving, you're looking at this. You're looking at one tiny little area to see what it's going to do. If it breaks down, then I know I'm looking down. If it breaks up, then I know I'm looking up. Real simple. I off the trend line, you could have gotten in this instance. But for me, I didn't get in there. I waited till it came up here. It's in. It retests off. It retests in here. You see this? It retests. And then it goes on this candle right here. This candle right here. There's your entry. There's your entry. Because you got your up movement. You waited for your retest. And on this third candle, this is where I got in. Now, this is where the money's at. Now, you say, well, what about this? You missed all that. Well, sure, I did. I missed that. However, that was, you know, maybe not a 50-50. I'd probably say this was like a 60-40, maybe a 70-30 at best. This year was like a 90-10. This, once I saw that retest, this was happening. This was happening, okay? Once this here, I can say, well, you know, it could get to here, and then, I move some. Hang on. This one could get to this little line, and then come back down, and then come back. You know, you still have a little bit of flag, you know, a little triangle here. But in here, once it got in there and retested and did not break back outside, I knew this one was going. So that's where you get in. Boom. And you ride it. And you go all the way up. Now, here's probably somewhere in here is probably your take profit 1. Somewhere in here is probably your take profit 2. But for me, I use a trailing stop loss. I get in here. My stop loss was down here. Okay. And then as soon as I broke that zone, I knew I would have to retest off that zone. It would have to break all the way through there in order for me to lose. So from there, I moved my stop loss into the zone. So at that point, my risk was large for a second, but small after minutes. Literally, before one candle was out, my risk was into the zone, and I had very little risk at all. My risk here, my reward here. Beautiful thing. Really, my first reward here, second reward here, and then the next structure is all the way up here. Okay, so now watch this. I'm going to show you something that's another pretty amazing thing. Mind you, I have not looked at an indicator. This is all based on market structure. Okay, this is all based on price action. This is all based on what the market all by itself is telling me. This is nothing but basic 1 through 4. Nothing but basic 1 through 4. Okay, maybe a little bit of technical analysis, understanding zones, but this is very, very basic. Now, watch this. So let me come back to here. Let me spread that out so you can see it real good. So now you can see that structure a little bit better. I'm not going to get into Bollinger Bands and moving averages, how things work tonight, but just to show you what I do. I don't trade my indicator. I use my indicator for confirmation. I want my indicator to tell me what I'm already seeing. If my indicator is telling me what I'm seeing, that it is true, then that's a confirmation. It's not, I don't find the trade on the indicator. I find the trade in my structure, but then I confirm the trade in my indicator. Does that make sense? And I also find continuation for my trade in the indicator. So I'm coming off my trend line. Kiss my trend line right there. That big bullish candle comes up, and my 9 moving average crosses over my middle Bollinger Band. It kisses it right there. So now I'm waiting for the retest. When that retest comes on a red candle, that 9 moving average should drop. Because remember, indicators are doing what the price is telling it to do. I have up, down movement, back up. My 9 moving average crosses. Now I have a confirmed uptrend. Now I have a confirmed up move on my 9 moving average crossing over my middle Bollinger Band. In here, my Bollinger Bands came in for a pinch. okay, which means sideways movement, right? That's why you saw that right here. Now you start to see them spread out again, which means volume, noise is coming. There's about to be some strength in the move. And what happens? Wow. Now my Bollinger Band is telling me I'm wide open. There's not a sell in sight. Look how close my 9 moving average is to the up. It rarely gets us that close to the top Bollinger Band. My 9 moving average is pointing directly up. My 9 moving average is going to do what the market is doing. My Bollinger Bands are going to tell me volume. And so here's what's happening. I've got wide open volume, strength, wide open strength in my Bollinger Bands. I've already confirmed everything on market structure. I have already confirmed that I was in a buy, since on the little candle, I was pointing straight up, which is why on the bigger candle, I can find entry. Now I'm wide open into a buy, and look what happens. Watch my indicators as I look for confirmation to, now I'm already in the trade as I find confirmation to stay in the trade. Look at this. Look at, I have a red candle. That's a, look, let me show you something, how substantial that is. Let me measure that from the top of the wick to the bottom. That is a 65 pip candle. How many of you would like to catch 65 pips on a trade? Right? That's a 65 pip candle. That is a major move down. 65 pips is strong. But my 9 moving average is pointing directly up. My Bollinger Bands are still open wide. I don't even have a thought about staying in this trade right now. I am not worried about that red right now. Oh man, I'm down 65 pips. The beginner says, well man, I'm losing 65 pips of my profit. I'm freaking out right now. But the experienced trader who trusts what they saw over here says, these are telling me that I'm still going to be able to be staying in. This tells me that structure still tells me I should be in a buy. So right now I stay in a buy. I start to get more green movement. Guys, this is everything we need. This is everything we need. And I want to show you something. That little candle right there, and not that it's a major cause, but that little red candle right there is the first sign of caution about continuing up, because you have a nice wick on the top side. Even though you had one here, that's look at this candle, is a lot different. And then I have a green candle to start the new week. Watch this. Any caution that I had about staying in because my 9 was curving down, look at that. This comes back all the way down to my middle Bollinger Band. I'm starting to come back in. So at this point, that at this red candle, remember I told you there was caution here, and then this red candle, when I have 2 wicks like that, I'm looking like, I probably not want to be in. First of all, I wouldn't have stayed in over the weekend anyway. But I'm just saying, if you're still in this trade, at this point, you're like, all right, I probably want to be out of this trade. Okay? So now you want to be out. I want to show you something very important here. The candle came below the middle Bollinger Band. My Bollinger Bands, let me squeeze them in again. My Bollinger Bands started coming back in for the pinch. My 9 moving average came right back to my middle Bollinger Band. I came and my chart told me sell, right? This is what it came, even below my middle Bollinger Band. It retested that very structure that we were looking at earlier. Why am I not afraid? Well, number one, because I know that that's a retest area, and that's a strong retest area that's probably going to send it back up. My confirmation of that is that my 9 moving average, if this was going to be a sell, then my 9 moving average would have to cross over my middle Bollinger Band. If this is going to continue to be a sell, my 9 moving average would have to cross over my middle Bollinger Band. And even at its lowest point, it kissed but never crossed. Now it does a little cross right there, more like a kiss, crosses over, comes down, touches my bottom Bollinger Band. So at this point, I don't want to be in this trade. I don't want to play around on this right here because either it's going to bounce and go or it's going to break and go down. So now I've caught all that and I'm waiting to see what happens here. I wait. There's my retest again. That big move up, even with a big wick. Here's my cross. Even a red candle, and I still have my cross. So where's my entry? Right there. There's my strong move up. Come all the way down, my strong move up, my retest, my crossover, my entry. Right on that little candle. There we go, widening out again. And just like it did the last time, I've got movement. Guys, everything we need is found in market structure. Everything we need is found in what the price is telling us already. We don't got to try to tell the market what to do. The market's going to tell us what to do. So I hope that makes sense to you. Again, just to kind of confirm what I'm saying. I find my structure. I test my structure. I find the breakout in my structure. That's when I enter. I use my crossover for the initial entry as far as the confirmation of it. I use my crossover and my moving average to determine whether I should stay in the trade and the volume and the strength of the trade. I use my market structure to tell me when I'm about to come into zones that I need to watch and be cautious of. And I make sure that everything I do and everything that I see has to agree with market structure. I don't try to make market structure agree with indicators. I try to make indicators agree with market structure, if you can see the difference. Okay. Last thing I want to show you, and then I'm going to turn it back over to Matt. Remember those numbers we talked about in the beginning? Those even numbers, those quarters theory, the quarter point numbers. I want to show you something interesting. Remember those zones? Each one of these zones that we're looking at? Watch this. Let's drop a line. Let's name this line. $1.78. Nice round even number. Look at that structure. In fact, I'll make this a different color so you can see it. Let's make it. What's the color I haven't used? Let's make it pink. Okay. I'll even make it a little thicker for you. So there's one. Let's try. How about we try $1.79? How about we try $1.80? Okay, let's even go lower. Let's try $1.76. Let's try. Oh. try $1.77. Does that make sense to you guys? I'm telling you that this quarter point understanding of supply and demand zones, the understanding of quarter points will change the way you trade. If you will understand that market structure is everything you need, don't look for the next best indicator. Oh, they're coming out with, this thing. It's a new theory. If you add this indicator to this indicator and do this and do that, you'll find. Stop. Just stop that. The market is not going to lie to you. Just look at market theory or market structure. Look at the integrity of market structure. It withstands every fad. It withstands every strategy and theory. It withstands everything because everything is about the strength of currency. Everything is about the strength of currency. If currency is strong, it goes up. If currency is weak, it goes down. That's the bottom line. Indicators are not telling. I'm not bashing indicators, guys. I use them, as you can see. I'm just saying that in the next cool thing, the next, IML, oh, this one came out with a new strategy. This one came out with a new strategy. This one, look, stop. You don't need every new strategy that comes along. You just need the candlesticks. That's it. You just need the market. That's it. The market will tell you everything you need to know. I hope that makes sense, guys. Matt, are you still with us?
Joe, I am. Guys, did that help everybody?
I hope that's been a help, guys. If there's any questions, I'll be happy to
I try to make them be honest, right, guys? 111 in the chat box if it helped. 222 if you guys confused, have any questions. All right, we'll keep Joe here as long as we need to answer some questions. I'll break the ice. You're not missing anything with the Lions game at all.
Yes, I've got it on the screen in front of me. So if you've seen my eyes drift up, I happen to be looking at the Jets.
If we see your camera go off, you're crying, right? Yeah. So awesome, guys. So let's open it up give you guys 30 seconds to type any questions for Joe. See if you have any. But yeah, definitely appreciate you coming out tonight. That was great.
Absolutely, man. He said I cursed the Jets. Kevin, we ain't friends, man. This is the last time. I'm gonna make my trainings private now.
Oh man.
Awesome.
Awesome, and guys, that's a good point that Joe made all night, right? Using the indicators to confirm market structure, right? It's something that we've talked about before, how how the indicators are always lagging, right? You guys know on my screen I use a lot of indicators that we try to put together, right? But that being said, we always look at the market structure first, right? And then we go back and we try to find those indicators that we say converge, right? To make sure that we get that confirmation that we're looking for. So like you said, we're always using the market structure. We're using the indicators to confirm that. And then we're using the correlations to confirm that yet again, right? And then we get in.